please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to the final of our four-part pre-budget economy series, The Growth Deficit Balance. We have in the past few episodes discussed how the government should implement its farm focus or its infra push. Today we have a panel of economists who closely track every number in that budget table grid to tell us what are the big numbers we need to concentrate on, what will make for a credible budget. I have with me Ashima Goyal, member of the Prime Minister's Economic Advisory Council, Samiran Chakraborty, the chief economist at Citi India, Deepali Bhargava, the economist from Credit Suisse, and Sajjid Chinoy, the economist from JPMorgan India. Ladies and gentlemen, it's a 50-50 house. Thank you very much for joining us today. Ashima, let me start with you. Which is that one or two or three big numbers that you will watch out for?
Yeah, I will look at the composition of government expenditure, I think. That's the most important. I would like to see a lot of spending on infrastructure and on agriculture also from the infrastructure point of view. And some maintenance of, I would also look at the revenue numbers to see, because we are expecting some improvement in direct tax collection. And also the GST numbers. So a lot of reforms have been undertaken.
Yep.
We would like to see a picture of that in this budget. And rather than populism, focus on infrastructure and productivity improvements through the compositional effects.
I have actually a wide range of estimates from experts on what will be this year's indirect tax revenue. I have one person telling me that it would be minus 1%, 1% telling me it would be minus 8% vis-a-vis target, and 1% telling me that it will be plus 1% vis-a-vis target. You know, tax revenues for the current year itself, where do you stand, Samiran?
For FY18, the reason why you are possibly getting a wide variety of estimates on where the tax revenues could be is on the indirect tax side. The seasonality that we have witnessed in earlier years in excise tax collection in March, where the March number used to be almost double the February number, whether the same amount of seasonality is going to be seen in this year's GST collections or not is one open question. The other open question is that whether the March GST collection will be accounted for in this year's budget versus next year's budget. And the third open question is that the almost 30% of unallocated IGST, how much will it be on March 31st? Because on a cash accounting system, that unallocated GST to some extent gets calculated as part of center's revenue. So because of these uncertainties, it's becoming very difficult to predict a more clearer number on the indirect tax collection for FY18. For direct tax collection, things are relatively much better. We are tracking the expected run rate, in fact, maybe doing a tad better than what we were. So if we get some clarity on the indirect tax numbers, then we'll probably know for sure that whether we're going to meet that target or not. We are working with an assumption that apart from the 13,000 crore shortfall which we would see because of the excise duty cut on petrol, diesel, we'll probably see another 15,000 crore shortfall coming out of GST. So that's the net shortfall that we are working with for FY18.
You're working with a shortfall of, say, 1% on indirect tax?
No, much lower, 0.2% 0.2% of GDP shortfall for indirect taxes. Okay,
so indirect taxes did 8.6 lakh crore in FY17, and the expectation is that it should have done 9.3 lakh crore. There comes the problem. Ashima, Deepali, what are your numbers in terms of tax collections, direct and indirect, for the current year? Do you expect GST collections and therefore overall tax revenues to meet targets?
Right. So, Latha, for the indirect tax collections, we have a 0% year-on-year growth in our revised estimates. And we are expecting a pickup in the next year, but overall, assuming that indirect tax is about 0%, it doesn't grow at all compared to last year. We have a total receipt shortfall of about 0.9 trillion, almost a trillion shortfall this year. So some part of it is obviously coming from indirect taxes, because GST is going to be only for 8 months. And not 9 months, so we're assuming the March number doesn't come in, doesn't get accounted for in this year, and we've already assumed that the unallocated IGST is going to the center. So I think we have some bit of optimism already built into the numbers. So indirect taxes plus the shortfall that we're likely to see on the non-tax collection side should set you back by approximately by 1 trillion. On the direct tax, broadly agree with Samiran that direct taxes are doing pretty well. On the income tax filings have increased, so you should see a robust 20% plus kind of year-on-year growth. On corporate tax as well, I think we penciling in around a 12-13% year-on-year growth, so no real big surprises there. And we're even more optimistic for a revenue for next year. We don't think receipts be so much of a concern next year.
Fair point. Sajjid, with this, let me come to the more credible expectations for next year. Since the consensus appears to be that tax revenues this year are going to be flat to maybe marginally lower, what can be a credible expectation for next year?
So a few things I would look at, Latha. One is, what is the nominal GDP assumption, because, the tax buoyancy is typically based on that. The CSO estimates this year to be 9.5. I think that, that will be slightly higher when the final outturn comes. We're looking closer to 10.3. Next year, we expect both GDP growth to pick up and the GDP deflator to pick up. So I think a number of 11.5% would seem quite credible. Now, on that nominal GDP assumption, remember, direct taxes this year will grow close to 15%, both corporate and income, on a nominal GDP base of 10%. Now, there are some one-offs over there as well, but that's a buoyancy of 1.5. The government can legitimately say next year, with growth picking up, at least in the direct tax front, buoyancy can be slightly higher. That's one positive. The second is, just the mechanical aspect that next year you'll get 12 months GST revenue. This year you got 11 months. So that adds about 50,000 crore, or about, close to 0.3% of GDP. So when looking at the buoyancy of indirect taxes, first take out 50,000 crore to look at the underlying buoyancy. Now, I think that is the key assumption here. We're being a little bit conservative. We're saying buoyancy will be accounting for the one-off close to 1, maybe 1.1. Anything higher than that might be a bit of a stretch. So I think those are the 3-4 numbers I would look at.
Okay, fine. That's a lot of numbers, but I want you all to quickly give me those 3 key numbers. What are your nominal GDP expectations, and therefore which is that direct tax number, 15%, 16%, not direct tax, sorry, which is the exact revenue growth number that you will consider credible? Samiran, first, what's the nominal GDP number you're working with, and what is the tax revenue growth percentage?
We are working with a number of 11.5 to 12% on nominal GDP, and on that basis calling for about a 12.9, 13% growth in total revenue,
okay,
including the non-tax revenue. So for tax, we are working with about a 11.5% year-over-year growth, so which will translate into about 11.4% of GDP of total tax revenue.
Sure. Deepali, what would your numbers be?
Right, so for nominal we have 10.2 for this year and 11.5 for next year. Net tax revenue growth for this year is 9%, and we're seeing a big jump of about 17% next year.
Ashima, I want a qualitative comment from you. Would a 13% revenue growth tax revenue growth assumption be fine? Because I'm getting a range from 13% to 17% revenue growth next year. What will make you call the tax revenue assumptions for the centre a good one?
Yeah, I think we should remember that we've gone through a lot of structural reforms this year, and we should see them fructifying in the next year. So, and also that global growth is going to be high,
yes,
and we are now in a position to take advantage of it. I would expect exports to rise. And moreover, whenever oil prices are a little higher, and we don't expect them to go above this because there are many factors keeping them stable, then our exports, non-oil, oil as well as non-oil exports do much better. So if you expect higher growth, then your nominal GDP growth could be higher. and therefore tax revenue also, since you would see that GST should settle down and deliver some improvements, as well as following up on all the leads they got with demonetization on direct tax. We've already seen a lot of buoyancy there. So I would believe that we could see, it would be closer to 15%, in the higher end of that band.
Okay.
The growth in tax revenue.
Yeah. So,
and the last point I wanted to make was non-tax revenue, because asset prices are very, very high. Right? So it's a very good time to divest. Air India, we could see a lot of movement there. Okay. And a lot of revenue coming from those.
Okay. Well, so primarily if the nominal GDP assumption is close to 12% and the revenue growth assumption is even over 15%, there are believers in my very credible panel of experts. Pre-budget economy series, the growth deficit balance. We have been speaking with Ashima Goyal of the PMEAC, Samiran Chakraborty of Citi, Sajjid Chinoy of JPM, and Deepali Bhargava of Credit Suisse. Well, we've discussed what can be the nominal GDP growth that the government can assume reasonably and what tax revenues it can assume. Now let's come to the expenditure numbers. Samiran, what would be your assumption in terms of expenditure growth?
So at a very broad philosophical level, we have taken a call that this is too early for the government to turn populist in this year's budget. So that's why we are expecting that the expenditure growth number would be a tad lower than the nominal GDP growth number. Yes, there are a bit of risks around how much of oil subsidy increase they will have to budget for, and to what extent there would have to be more money allocated for rural and infra. But even with reasonable assumptions, we think that it's possible to get around 10.5% of expenditure growth for next year, which should be okay given that growth is already picking up and we don't really require a large dose of fiscal stimulus at this moment.
What's your deficit number expectation, both percentage and aggregate?
So we are getting into about 23 plus only on total expenditure, 23 trillion plus. So that should give us a fiscal deficit of about 3.2% of GDP for next year, vis-a-vis 3.5% for this year.
Okay. Deepali, what would be your expenditure number, and more importantly, the two deficit numbers, percentage and aggregate?
Right. So, Latha, we're working with 3.4% of GDP for this year and 3.2% for next year. So for next year, if you look at it, receipts are going to be higher by about 0.4% of GDP. I think the government will partly use this space to cut down on deficit and partly to increase expenditure. So in our numbers, we have a 3% slip in expenditure for this year, and which gives you a 13% year-on-year growth for next year, which roughly gets to about 23.5 trillion worth of overall spending next year.
Fair enough. What would be the corresponding numbers for you, Sajjid, the expenditure growth and deficit numbers?
So my sense is next year you will see higher expenditure, more than nominal GDP. So on a base of 12% nominal GDP, I would expect expenditure growth to be more than 13 to 14%. I think in particular there'll be much more capital expenditures, because this year, given the actual outturn last year, capex budgeted is only going to grow at 6.7%, and they'll be cutting some of it in the next few months. So the actual growth rate this year could be closer to 5%. On that base, I think the government will be very keen to boost capex. So our sense is, as a percent of GDP, expenditure goes up by between 0.1 and 0.2. I think the key is going to be how you budget subsidies, because if you have much higher expenditures but you haven't fully allocated for subsidies with oil prices at 70, that could be a problem later in the year. Our deficit number this year is 3.4%. Next year it's going to be 3.2.
Ashima, to come to you, and you know, we've always struggled to get to 2% of GDP as our capex expenditure. Every year we fall short and get to 1.8 or 1.9, and looks like that will be the trend in FY18 as well. What will qualify as a good budget for you in terms of expenditure quality?
Yeah, as I said, infrastructure expenditure is important, but there also you can leverage on expected rise, and through this EPC they're doing some of this, so you can spend and you can leverage private expenditures also. So you can give a bigger impulse to infrastructure spending, and that is also a good thing to do because non-tradable goods expenditure creates more internal demand, as well as removes bottlenecks.
And 3.2 is healthy, you will think, because actually 3.2 is not achieving the target of 3. Okay for you, Ashima?
No, I think that there's been some miscommunication here because this markets expect that path and therefore 3%. I think the communication should be that given our expected growth and the sort of comfort we have in terms of the relative, our growth rates are much higher than real interest rates. So we can achieve very healthy debt levels even with wider deficits.
Okay.
And I think that communication should go to markets.
Oh, I don't think the markets will be very happy with that.
Announced that.
I'm not very sure. In fact, that is my final set of questions. Samiran, will 3.2 be taken in a benign manner by the bond markets? And on the contrary, I mean, in contradistinction to what Ashima is saying, will it be better for the bond markets if the government accepted the encasing report in some fashion and actually gave a glide path?
So 3 points, Latha. First is that on a very broad sense, any fiscal deficit reduction, the glide path being followed is good news for bond markets. Second is any acceptance of the encasing committee report, particularly with respect to fiscal council, etc., should be taken positively also. But I think the bigger problem is the gross borrowing estimate that will come out of this fiscal deficit number. So a 3.2% of GDP fiscal deficit can also lead to significantly wide variation in estimates of how much will be the net borrowing number and gross borrowing number, because you'll have to add the buybacks, the switches, and how much will be from small savings. If you recall, last year they had budgeted for 1 trillion rupees of small savings. For the first 8 months, we have got only about 55,000 crores. So based on all that, we have to look at the bond market impact, because a large gross borrowing number today, where the market is really looking for the incremental buyer, could be a bit of a concern. The bigger challenge in my mind today is who is going to be the incremental buyer rather than what is going to be the incremental supply.
Okay. Well, actually, I'm just looking for the exact net and gross borrowing number. Would you have one, Deepali?
Yeah, so for the centre, we're looking at a net borrowing of about 4.7. I think about 2 trillion worth of redemption. So the numbers should be close to 6.7, 6.8 on a gross level. But Latha, I wanted to highlight 2 points on the net borrowing and the demand supply debate, which is really net borrowing is what really hits the market is centre plus state. So if you look at both of them put together, I think we are pleasantly surprised by what's going on the state finances part. So as a percent of GDP, your state plus centre net should be lower this year, and we're factoring in for a lower number next year as well. So there is higher comfort with state finances, which is positive for the bond market. And secondly, from the demand supply perspective as well, with higher deposit growth next year, RBI likely being a net buyer than a net seller, and small savings, although obviously with a bit of correction next year as more allocation is happening towards equity, we're still expecting small savings to be more robust. So I think from a demand supply perspective, we will probably see a better balance than next year than what we saw this year. So we think that probably there is still scope for bond yields to consolidate overall.
Sajjid, final 2 numbers from you. What is your net and gross number?
So we're in the same ballpark. Our net number is, close to between 4.6 and 4.8 trillion. The gross number is closer to 6.5 trillion. But I think the larger point here is how, adding the point that was made by Deepali about centre and states. State borrowing is still 15% higher this year. So as a percent of GDP will still be greater. And total issuance this year, centre, state and RBI, the fact that they did sales versus OMO purchases was 50% higher than last year. So the key is going to be, given currency in circulation, but also given the fact, Latha, that we still have a large BOP surplus. So if to the extent that the RBI is intervening in the FX market and creating base money, that at some point will counter the fact that currency in circulation is picking up. So I think ultimately Samiran's point is the right one. Issuance could change by 30, 40, 50,000 crore. Where is the incremental demand going to come from? Given that foreigner limits are full, the RBI may be forced to sell at some point next year, and banks are already holding much more than they desired to, and with deposit growth weak, the marginal propensity to buy by banks is very low. So I worry about the dynamics in the bond market going forward. That in turn pushes up corporate bond yields, as we've discussed before.
All right, that's a lot of numbers all of you have put on the table. Thank you very much for joining me. The key things that our experts believe will make for a good budget is deficit should be 3.2% or below. The tax growth assumption can be between 13 to 17% as well, and they would still consider it a good budget. That gives the government a lot of leeway. But the borrowing number, that will be important. If the borrowing number is too big, anything more than that 4.5 lakh crore, the bond markets would worry. Thank you very much for joining me in the final edition of our pre-budget economy series, The Growth Deficit Balance.